Hey guys, welcome back to the complete foundation stock trading course. In this lecture, we're going to be talking about the relative strength indicator, or the RSI. Now, the RSI is another technical indicator that we use that is extremely popular and extremely useful to predict price movement. Now, you might have heard about RSI before, or you might have used it before. Even if you haven't, I'm going to explain exactly what it means and when and why you would want to use it. Okay? So you might have heard a lot of times people saying, hey, this stock is overbought or this stock is oversold. So to figure out if a stock is overbought or oversold, one of the indicators that we can use for that is actually the relative strength indicator. Okay? So how is the relative strength indicator calculated? Because if you look at the chart I have here on the screen, you can see the fluctuations of the chart. And then at the bottom of the screen, you can see your indicator. Okay? And this indicator, again, like all other technical indicators, they are calculated using the prices of the stock, right? So they use these prices to calculate the indicator. Now, the RSI actually is going to be an indicator that fluctuates between 0 and 100. Okay? And the actual function for it, let me go here on Google. I'll get this up. Okay, RSI formula. So the actual formula for the RSI is going to be 100 minus 100 divided by 1 plus the relative strength. And the relative strength is just going to be your average gain days divided by your average loss days. Now, you don't need to understand the formula. You need to understand how they come up with this number. And that's what I'm going to explain right now. So when you were looking, and let me actually put this back up here. When you were looking at the average gain and average loss, you're actually looking at the previous days, right? So what they actually do, and let me actually draw it up here. What they're doing is they're taking a stock and they're looking over X number of days, okay? So again, like with all indicators, X can be, 20 days, 100 days, 200 days. Different indicators usually have a default, and most people like to use that default because everybody else is using it. For RSI, most people, and the default is usually 14. So a lot of people use the last 14 days in the RSI. Again, you can change it, you can try other things, but most people use 14 days. Now, when we looked at the function earlier, and it's RSI equals 100 minus, and let's pull it up here just to make sure I got it correct, because at the end of the day, honestly, you don't care about remembering how they calculate something, but you just want to understand the meaning behind it. So let's put it up here. 100 minus 100 divided by 1 plus RS, and where we said RS is going to be your average gain divided by your average loss. So what do we say? What do we mean about average gain? So what we actually mean is we're going to look at our green candles, okay, when the stock is going up, okay, and then we're going to be looking at our red candles, so when the stock is going down. So maybe here it goes down a bit, here it goes down a bit again, and then we have a very big green candle, and let's say we have a bunch of small red candles, and let's say another green candle up to here. So let's say this is 14 days, okay? So what we're going to be doing, we're going to actually be taking all the gains, all the green candles, okay, So this one, this one, this one, this one, this one, we have 1, 2, 3, 4, 5. And red, we have 1, 2, 3, 4, 5, 6. So 11 days. Let me add 3 more, just like that. So another green one. And let's say 2 other red ones. Okay. So we have 14 days, 14 trading days. We're going to be looking at the average gains. So over these 14 days, we're going to take all the positive days, all the gaining days, and we're going to look at what is the average of their move, okay? And then, so let's say the average here is about, X percentage, right? So, it could be 2%, could be 3%. But then we're going to look at the losing days, and we're going to see what is the average of the losing days. And here we see that the losing days are always, the average is way smaller than the winning days. You can see that the winning days, the candles are way bigger, right? Okay. That means that buyers were way more aggressive buying the stock. They were impatient. They were willing to buy at a way higher price, okay? So demand was extremely high because you see that the candles are bigger, right? So when you end up computing the RSI, you're going to get a number that's going to fluctuate, like we've said, between 100 and 0. The lower the number is, okay, the closer it is to 0, that means the stock has a lot, or actually let me say this, the higher it is, the closer it is to 100, that means the bigger the green candles were compared to the red candles. So if the green candles are very big and the red candles are very small, well, the number is going to be bigger. Okay, we're going to get closer to 100. And that means that the stock is overbought. Okay, so when you have a number that's close to 100, which is the upper band, that means that the stock is overbought. Okay, so in this situation where you see the green candles are way bigger than the red candles, it might tell me, okay, this stock is overbought. A lot of people are buying it. Okay, so it's really up. They're way more aggressive in their buying. If the RSI gives us something that's closer to 0, that would mean that it's oversold. And if it gives us something closer to 0, it would mean that the red candles are way bigger than the green candles, right? Now, general rule of thumb, we usually look at the 70 line and the 30 line. And again, the RSI is going to fluctuate with time, okay? It's sometimes going to go higher as, green candles get bigger. And then as, if red candles get bigger, then it might fall down. So they're going to fluctuate. And the rule of thumb is if it's below 30, it means that it's oversold. And if it's over 70, it's going to be overbought. Okay? Again, when we're saying oversold, that means the red candles were way bigger, so people sold them so much more aggressively that they took a beating. Okay? It's too much. Shouldn't be as down. And when the green candles are way big, means it's overbought. Now, what should you do knowing this? Should you buy something when it's oversold? And the actual answer is no, because something can stay oversold for an extremely long time. Stocks that go all the way to 0 are they were oversold for a long time. And does that mean you should short when it's overbought? No, because also it could just it could stay overbought for a long time. The stock can just keep going up. The way you should do it is this. Once a stock becomes overbought, don't short it yet. But if it stops being overbought, so it became overbought, but then it stopped being overbought, which means what? Which means, the momentum stopped and now there's bigger red candles. That's when you short. You short as it stops being overbought. Okay? And then as it goes down, then you make your money. And if it becomes oversold, you don't buy right away, okay? You don't buy right away. You wait until it stops being oversold. So you wait as it breaks from below the lower price target, and that's when you buy, okay? So a little example here. Let's see right here. In this situation, you can see that the stock is going that. Okay, well, actually, let's see here. We're looking at the RSI, 14 period RSI, 14 days, and you can see that the RSI becomes overbought. So we don't short the stock because it's overbought. We're gonna wait, but then as it stops being overbought, that's when we short. And you can see it would have given us a good entry here and would have made some money. Now, the stock drops, and you can see that it became oversold. Now, why did it become oversold? Easy. Look, the red candles became way bigger than the few green candles that there are in this last 14 days. So it became oversold. Now, at one point, the red candles become smaller and the green candles became bigger. And you see red candles became way smaller. So what happened? The RSI stopped being oversold. Okay, so bam, that's when we buy. And again, good entry. Again here, became overbought. And you understand, it became overbought. Why? Because the green candles compared to the red candles are way bigger in these last 14 days. So it became overbought. Again, stopped being overbought and went down. Oversold again, don't buy right away because you don't know. But as it breaks up, that's when you get your entry. So that's the way you should use relative strength indicator. Now, you've realized from this indicator, like the other indicator we talked about in the last lecture, the Bollinger Bands, that you don't actually need this. You can see everything through the chart because all technical indicators are derived from charts. So if you look at the chart close enough, you can see the size of the candles and you can know if it's overbought or oversold. But the indicators are very good because they help you see this more easily, right? So you have to use them. I'm not saying don't use them. I'm just saying understand them, right? Because then when you look at the chart, you're going to understand why it's that. Now, should you use this indicator on anything? And actually, let me pull up. Let's go on TradingView. Okay, what is the stock? Okay, let's like, I don't know what that stock is, but let's try it on that stock. So compare. Let's see. Nope, not compare. Sorry, indicator. We're gonna put relative strength indicator or RSI. Oops, RSI, and here we go. First one. Click on it. Here's the RSI. Let's see if it would have worked. Okay, so we have RSI dropped. And let me just close this a bit. Let me take this here. RSI drops below, breaks over. Okay, so that gives us a buy indicator here. Buy indicator is here, and whoop, perfect. So that's a good buy. Let's see here again. Buy indicator here. Perfect. Okay. Again, nothing here, nothing here, nothing here. Oh, so here it drops, right? So we don't buy it because imagine we bought it here. Look, it kept going down. If we bought it here, as soon as it broke and it became oversold, right? We shouldn't have bought right away, right? Because look, it kept going down. But when do we buy? When it stops being oversold. So here, this is our buy entry. And wow, it's working like a charm on that stock, right? So super nice, okay? And again, here, another drop. So buy entry here. Honestly, all of these buys were good. Not even one losing trade, so super good. And that was a random stock that I looked at. So let's see at this RSI here. I'm gonna double click on it. Okay, so this RSI is actually using a 7 days instead of a 14 days. Is it that right? It should default at 14 days. Let's see. I'm gonna put it again. Insert indicator. RSI, relative strength. Yeah, it's using 7 days. Okay, if we put it at 14, we would have got a trade here. Okay, so a few less good trades. So you might want to play around with, okay, well, I'm not actually looking at the same stock anymore. Which stock were we looking at? Obviously, now we're on Forex, so it's not going to work well with Forex, obviously. But what I want to say is you can play around with different lengths, you know, how many days, but usually people keep it at 14. So you want to stay with what other people are using as well, because again, like we've talked, and I keep drilling that in because it's super important. It's not just what you look at, it's what other people look at that matters, right? The reason you're looking at it, the reason you're trading is you're trying to predict what other people are going to be doing. So you got to look at something that other people look at. So 14 days is super good. And that being said, something that's very important, okay, is what type of stock you're going to use it on, right? You can't use all indicators on all stocks, right? So this type of indicator is going to work extremely well for a specific type of strategy and specific type of stocks. On the one we just saw, and I don't remember which one was that, it was randomly on my chart, but it looked good on that one. Okay, I don't know what company that is, but it depends what type of stock, which indicator you should use, and what type of strategy. So obviously, you're not going to use a overbought or oversold indicator like the RSI on a biotech company, right? That's that might get a new drug patent, or it could get FDA approval at any time, or can go up 50%. You know, if a biotech company is overbought and it stops being overbought, it doesn't really mean anything. These things can move in any type of way at any time. So you're not going to use it on that type of stock. Are you going to use it on a momentum strategy where you think something is going to keep going in a direction? No, you're going to use it on a mean reversion strategy where you think something is coming back. Now, again, mean reversion strategies, momentum strategies, we talked about that in our advanced course. It's more advanced material, but you have to know that all indicators all work under different strategies and different stocks. So make sure that you're going to be using this. And again, this one you should use for mean reverting strategies and value stocks. Now, again, this is a little bit outside of the scope of this course. Check it out in our advanced course if you're interested in that. But just make sure that you don't just use it across the board. Okay? There's too many stocks out there. You got to take your universe of stocks and subset it into many parts, many symbols that work well with different indicators and different strategies. All right. So that being said, this is going to cover the RSI, and I will see you in the next lecture.